There's always going to be fear about the next stock market crash, and whether you've just started investing or whether you've been doing this for decades, it never goes away. However, what if there was a way of investing that meant you could still do well whether the market goes like this or even more like this? And even if the market does look like this, there is a way forward that means that you can come out on top. Now, let me show you how using this real world example. So if we go back to the global financial crisis and look at the stock market during that time, we'll see that it looks like a terrible time for investors. Taking the chart of the S&P 500 as our benchmark, you'll see that the market peaks in October of 2007. It then proceeds to fall almost 60% at its lowest point before finally recovering 6 years later. Looking at this chart, you might think, wow, I really hope that we don't get something like this over the next few years, as that is a horrible place to be. And all of your hard-earned money could end up being sat there doing nothing. Even worse, imagine being an investor who only just started to see the value of your stocks get cut in half. I'm sure in our audience there's some horror stories. Feel free to leave those in the comments below if you want to share. Now, the assumption here is that there is no way to make money as an investor if the market looks like this. But I want to show you something that might change your mind and reverse the way that you currently look at things, especially stock market crashes. First things first, I think the way we look at stock market crashes is a bit skewed. For example, the year-to-date return of the S&P 500 is almost 20% at the moment, but as investors, that's only relevant to us if we'd put all of our money in on the 1st of January and never done anything since. Likewise, it's the same story with the 5-year chart and the 10-year chart. Although it's nice to see those big green numbers, it doesn't reflect what we get in return, as it's only relevant if we'd put money in on those exact dates. If we invest at different times and we invest regularly, our returns look very different because we'll be buying at all kinds of different prices. As the market moves up and down, your average cost will change, and that's just life. However, this can be one of the most powerful tools you have, especially when the market's in a crash like it was back during the global financial crisis. So let's run an experiment. You might think that there's no way for you to make money as an investor when the market goes down. And even when the market recovers, surely you'll only be able to break even, but that is just not true at all. Let's say that you are able to invest a couple £100 back at the peak of the market starting in October 2007, the worst possible timing. You had no idea the crash was going to come and you were all excited to start on your journey. However, rather than stop investing as the market takes a turn, you remember everything you've been told about long-term investing. You don't try and time the market, you keep going, and you make sure that you dollar cost average every month as you get paid no matter what. So you grit your teeth, you carry on regardless, and you just end up not looking at your investments. Eventually, over the years, investing becomes a habit and you do it and it gets easier and easier. Between October 2007 and April 2013, the point where the market finally made it back to zero, there are a total of 66 months. So that's 66 months worth of investing several £100s, and where the early years are just horrible. Now, the big question is, was it all worth it and did you make any money? Surely, if the market is just back to level, then your investments are back to the same point, right? Well, here is where the magic of long-term investing comes in and gives you a lovely smack on the lips. That's the nice kind, not the garlic breath kind. So because you've been investing every month and not looking at the market, buying all the way down and all the way up, believe it or not, you would have actually made quite a lot of money. I'd also bet that you would have made way more money than any of your friends would have done who might have tried to time the market buying all kinds of random different stocks. So here's what the journey would have looked like. This first chart is your return on a 3-month basis. Now, as you can see, the first 2 years are all in the negative, and every time you put money in, it will feel very painful as the bottom of the market was still many months away. However, because you kept up with your deposits and kept buying over time as the market slowly recovered, you end up nicely in the green. Now let me show you another chart just to point out the bottom of the market. Not something nice to look at all. And I've got no idea if we'll ever see something like this again in the future and when that will come. Anyway, now for the good stuff. Here's the numbers behind this and the real returns of your money. So here is every single year that you would have been investing from 2007 until 2013. In total, the amount of money that you'd put in was £13,400, as this was £200 a month starting in October 2007, going all the way until April 2013. As you can see here, the total you end up with is £19,318. So So that is a profit of almost £6,000 during a period where the market literally only got back to where it was. Now, the reason for this is that between those 2 points, you were buying all the way down and all the way up. So your average cost ends up being between the bottom of the market and the break-even point. This means that with the magic of being a long-term investor and investing no matter what, you would have basically beaten one of the worst possible times to be an investor. During that same time period, we can only guess just how many people would have sold out or never invested again. You can bet that they're kicking themselves now and have a lot of regrets. Now, you might think that this is all quite obvious and easy, but I appreciate that none of this is easy, and this is all easier said than done. Investing, when everything around you is telling you not to, is very difficult. And these rewards are only there for those of you who actually walk the walk and don't just say you'll do it. On that note, I did just want to say that I have now got around to creating my investing community on Discord, and I'd love you to join if you want to be part of a place that we're going to talk about everything related to money, personal finance, and investing. Now, you can sign up in the link in the description, and once you've paid the small fee for a year's worth of access, you'll be able to jump right in. As the community grows, I'll be looking at doing exclusive events and live streams, so please watch this space and make sure you get in early. Oh, and if you're a running nerd and a gaming nerd, then I've also made a section for you too. I'll be over there hanging out once the video goes live. I'm looking forward to seeing who's first. Anyway, with that said, let me just get back to those numbers for a second and this real world example. What I wanted to highlight here was that long-term investing, especially long-term investing done regularly, is almost like a free superpower. The more time you spend investing, the longer you get to ride out the inevitable highs and lows, and especially those terrible crashes. We might not get one as bad for years, or we might have a couple of them in a short space of time. There is nobody who will know, but plenty of people will claim to know when they're coming, and you'll find plenty of those people on YouTube. All we can do, in my humble opinion, is to make sure that we stick to the plan even when faced with this knowledge. As long-term investors, you get this power because you don't have the same pressure as the rest of the market. You don't have to worry about any shareholders to worry about that might call you up saying, why haven't you made them 50% this year? And you've got nobody you need to impress on TV. As a regular person with absolutely no knowledge of the stock market, no fancy suits and expensive office buildings, you can do very well as an investor. It all comes down to that consistent investment over the long run. Now, just in case I haven't made myself clear, this strategy is not one that you can just apply to individual stocks, and this is only going to apply to buying low-cost, broad market index funds. Whether that's the S&P 500, a global fund, or just a developed world, that's up to you, and I've got loads of resources on the channel to help with that. I'm also working on my course in the background too. If you're interested in getting those details, make sure you signed up to my email list to find out when. Anyway, if you apply a strategy like this to individual stocks and companies, you're running a much bigger risk because there is no way of knowing if a single stock will rise back up with the market. There are so many examples of stocks that just keep on dipping and never come back, either going bankrupt or just staying flat and underperforming for years. Just to make this even clearer, I ran the numbers just then to see just how many companies in the US alone managed to match or beat the returns of the S&P 500 over the last decade. Out of the 8,395 listings that I can see currently on the US stock market, just 650 have managed to match or beat the return of the S&P 500 up until today. That means that 92% of the stock market is arguably not worth investing in if you were trying to pick those winners. So I'm not really sure I like those odds. In my view, as someone who is not your financial advisor, but does want to help people make better decisions, I think I know what I'd rather do. So it's index for me all the way. However, one more thing worth saying, just in case I get someone in the comment section who pulls me up on this one, I want to make it very clear that with investing at all, there are no guarantees. And this example in the global financial crisis is just an example. Hindsight is a wonderful thing. And all I wanted to show in this example was that making money as a long-term regular investor is possible during a time when the market crashes. I think only investing when the market is going up all the time, it's nice and easy, sounds great to do, but the reality is very different. And those real gains are made by those people with a strong stomach who just keep going no matter what, especially through the tough times when everyone around you is panicking with their hair on fire. Anyway, I'm looking forward to seeing you over in the community soon. Enjoy this next video, and as always, happy investing.